Hello, friends. Hope you all are doing well. And today we'll talk about the direct equity or the mutual fund. Like, what is the best for you? So, by the end of this video, we will know which is the better suited for your financial goal and risk appetites. So, if you talk about the mutual funds, it's been managed by the professional. The team of expert manage the mutual fund. And if you talk about the stock investing, it's you. You are the one who is investing your money in a stock in a company, and you are like becoming a part of the company, or you are becoming an owner of the company. So like there is two different thing, investing in the mutual funds, which has been managed by the professional, the expert, and then you are investing in a stock, which has been it's you are investing it by yourself. You are researching the company data, their financial, and their quarter on quarter result, and then you are putting your money. So we will try to find out like which is best for you. The investing in mutual fund or like investing in equity. So like as I say, if you are putting your money in mutual fund, they what they do is like they put your money in a different sectors, different company. So like they diversify your amount, across the multiple sector or the asset classes. Like if they put in the large cap equity funds, debt funds, hybrid funds. But if you are putting your money in directly stocks, you are becoming the owners of that company because you are buying directly share from them. You have a complete control on your buying and selling decision, but for that you need to have a good research and monitoring. Like if you are buying a stock from of like Asian Paints, TCS, or Wipro, like HAL, so you have like complete control about it. So like it's got to have some pros and cons. So if you talk about the risk, if you are putting your money directly to the stock, the risk is little higher, you know and but at the same time you get the good reward as well, because if you do the good research, you know and about the company, about the product services what they are offering, you will be getting the good returns as well. And if you talk about the mutual funds, it's diversify your risk. It does not put like all your money in couple of stocks. They diversify your money to the different sectors, different organization. But if you talk about the returns, stock potential gives high returns, but for that you need to have the good knowledge about the market. It's not just about the one company. You have to have the good knowledge about the market, the policies what government is making for the organizations or the sectors, their quarter on quarter results, their product, their peers, their competitors, their expansion classes. And like mutual funds are like moderate returns with the lower volatile. Mutual funds does not fluctuates a lot. Like in a day, like they will not I mean usually they don't go like 10%, 20%, but in stock they can go at any point of time on any day like 10% or 20% up or down. So that's what, like big things with the stocks. Time and effort. The stocks require the research intensive. you know it's you have to have very active. Like if you see, everybody puts their money to the stock market to get the good returns. And if you are putting your money and you don't know where you are putting it, how the company has been doing, where they have been issue with any of their product or services, or whether they are doing any kind of expansion or not. So you need to know about the company, about the sectors. You need to know the good information about our economy as well. But in the mutual funds, it's actively managed by the professional. They are the professional. They have the fund manager has been doing this work for the long time. He talk directly to the company. In some cases, you never know, these fund managers have good more information, because they talk directly to the organization. They know how things are working at the company side. So they get the good picture, clear pictures, so they diversify your money to the different sector. And if you talk about the investment amount in mutual fund, you can start with the very low amount. But for the stock, for if you want to invest in MRF or Page Industry or Ultratech, you have to have lot of money. Like for example, if you go to the MRF is currently running 1 lakh 11,000 around for 1 year. The Page Industry is running around 44,500. So if you want to buy one stock of Page Industries or MRF, you need to have the huge money. But for the mutual funds, you can go with the lower amount, or you can start SIP like 500 month, weekly, or anything, whatever suits for you. Okay. And so it's totally depend on you, what is good for you. There's few myths about the mutual fund investing versus stock, so we'll try to cover that as well. So people always say that mutual funds are always safer than the stocks. I mean, it's kind of it's kind of true, but it's not always true. Some mutual funds give good returns, like 18, 20, 30%. Some of them are like 7 to 8%, you know. And the another myth about the stock is it's guarantee high returns. That does not true. Like all the stocks are not moving upwards. Some of them have been moving downwards for last 10 years. Like if you talk about the Yes Bank or the Idea, they have been they're not performing well. So you need to a lot of money to. I mean, you need a lot of time to research about the company or organization. The another myth about that you need a lot of money to invest in either. I mean, that's not right. As I said, you can start with as much as you want with the mutual funds, but there is some good company or the large cap company in the stock equity as well, where you can start with where you don't have to put a lot of money. So definitely you can start with the low money as well, less money as well. Mutual funds are risk free. That's another myth. I mean, in the stock market, there is nothing called risk free. There is always risk involved in this market. And the another myth is equity is only for the rich person. That's again not true. Anybody can invest. It's all depend on how much you want to invest. What's your goal? What's your time horizon? So you can start small in equity or mutual funds wherever you want. Okay, so now we will try to find out who should invest in what. Like mutual fund is good for the beginners who does not have a lot of information, who does not have time to research, who does not have time to track keep track on the government policies or the organization policies and all. So it's for the lower uh, risk or moderate risk and long term goal. The mutual funds is very good. If you talk about the equity, it's the best for the experienced investor who can handle the risk, and it's also good for the individual who actively participate in the market, who keep track about the stocks, the government policies and all. So mutual funds, because mutual funds, what it does is it's diversify your portfolio, and it's give less stress because it does not volatile lot. But for the long term investor, I would say that you should be a part of the both. You should not be just going to the stock or the mutual fund. I would say that you should approaching the hybrid model where you should be investing some part of your money to the mutual funds and some part of your money to the stocks as well. So with this, I would say start small, stay consistent, and choose based on your goals. So use mutual fund for long term passive growth. Allocate a portion to equity for active growth and learning. So you gotta allocate your little bit of amount to the stock so that you can start learning about the sectors, the company, and the products and all. You know. And so again, there is no one size fit for all. So you have to keep uh, track about your investment, and you need to and you have to see your goals and risk appetites. So at the end, I would say that if you really like this conversation, or if you really like this video, share it, subscribe for the more investment tips, and let me know in the comment section. If you have any questions, feel free